Debit cards are enticing since they do not require borrowing money and do not accumulate debt, but they also do not assist you in establishing a credit history. One of the primary advantages of using a credit card is the ability to build credit. Others include What's up and welcome to Smart Money, where our mission is to give our viewers the motivation to make more money and the skills to keep it. In today's video, we're going to talk about how credit cards work. We're going to discuss what a credit card is, how credit cards and debit cards differ, different types of credit cards, and the reasons to get a credit card, so watch this video to the end for that. Do me a favor and hit the like button so that YouTube knows this is a good video and tells more people about the community we're building here on Smart Money. We have a goal of getting to 25 likes on this video, but we can't do it without your help. I have affiliate links in the description. If you choose to use them, I will be compensated, but at no extra cost to you. And without further ado, let's get to the video. What is a credit card? A credit card is a physical card that can be used to buy goods and services, make payments, or withdraw cash, depending on the card. A credit card can be thought of as a form of a short-term loan. A credit card is a plastic or metal card that enables you to access a credit line provided by the bank that issued the card. When you use a credit card to make a purchase, you are borrowing money from the card issuer to cover the cost of the purchase. You must then repay the funds either in full at the end of the month or over time. When you open up a credit card account, your credit card provider sets a credit limit for you. This is simply the amount of money that the credit card company enables you to spend or pay bills with. As you use the card, your available credit decreases. You then repay the credit card issuer for the amount you spent from your credit limit. Credit cards fit into two categories, either secured or unsecured. The most prevalent sort of credit card is an unsecured credit card. In this example, unsecured means that the debt is not secured by collateral, such as a deposit that the lender or card issuer can keep if you don't make payments. A cash deposit is required to open a secured credit card, which usually doubles as your credit limit. How does a credit card work? When you're approved for a credit card, the bank authorizes a credit limit, the maximum amount that you can borrow, which you can then use at your discretion. Your credit limit will be determined by factors such as your income, other debts, and the amount of accessible credit on other cards. Credit cards can be used to make online or in-store purchases as well as to pay bills. When you use a credit card for either one, the merchant's bank receives your credit card information. The bank next obtains authorization to process the transaction from the credit card network. Your card company must next validate your information and either approve or deny the transaction. If the transaction is approved, the payment is made to the merchant and the transaction amount is deducted from your card's available credit. Your card issuer will give you a statement at the conclusion of your billing cycle that includes all of the transactions for that month, your previous balance and new balance, the minimum payment needed, and the due date. Credit card transactions are processed through payment networks such as Visa, MasterCard, Discover, and American Express. They ensure that the purchase money is delivered to the merchant and that the correct cardholder is billed. When you receive your bill, you have the option of paying a minimum amount, the entire debt in full, or some sum in between. Paying only the bare minimum each month is ultimately the most expensive option because it costs the most in interests. The ideal option is to pay in full each month. When you pay in full each month, you have a grace period that allows you to avoid paying any interest on all purchases. The grace period is the time between the due date of a credit card purchase and the due date stated on your statement. There will be no interest charges if you pay your payment in full by the due date during this period. However, if you carry a balance from month to month, your credit card company may charge you interest. The annual percentage rate, or APR, on your credit card represents the expense of holding a balance on an annual basis. Your APR comprises your interest rate as well as any other fees, such as an annual fee if your card has one. The variable APR on most credit cards is connected to the prime rate. This means that the APR on your card can alter over time, while the Credit Card Act of 2009 establishes tight criteria for when the credit card firms can and cannot boost your rate. Your credit card company submits your payments to the credit bureaus, which produce credit reports. Your payment history accounts for 35% of your credit score, which is a 3-digit figure that reflects how hazardous it is for a lender to lend you money. To avoid late fines and potential credit score harm, you must pay at least the minimum amount by the due date each month. How do credit cards differ from other cards? Although a credit card and a debit card appear to be the same thing, they are not. When you use a credit card to make a purchase, you are not spending any of your own money at the time. Instead, you are spending the credit card company's money, which you must subsequently repay, maybe with interest. Debit cards. A debit card is linked to your checking account, and debit card purchases deduct funds from your account. You're paying for items with your own money rather than borrowing money from a lender. Some debit cards generate rewards, though they are often insignificant when compared to credit card rewards. Debit cards also have inferior anti-fraud safeguards. Debit and credit cards also have different effects on credit scores. Because your bank account activity is not reported to credit bureaus, using a debit card has no effect on your credit score. Credit cards. Credit cards, on the other hand, might have a direct impact on your credit score. For example, FICO credit ratings generate your scores based on payment history, credit usage, credit age, credit mix, inquiries for new credit. Making on-time credit card payments might enhance your score, however, paying late can decrease it. Similarly, holding a modest balance compared to your credit limit might help your score, however, maxing out your card limits will hurt it. Another significant distinction between debit and credit cards is fraud prevention. Credit cards have additional fraud protections under federal law that debit cards don't. We'll discuss your liability for illegal debit and credit card transactions later on in the video. Prepaid debit cards. A prepaid debit card is not tied to a bank account. Instead, you load the money onto the card and can only spend the amount you've loaded. These cards frequently levy fees that a standard debit card would not. Prepaid debit cards provide some safeguards, but they are not without restrictions. Some prepaid debit cards, for example, do not provide ATM access or mobile banking. Furthermore, not all merchants accept them. Because they do not involve borrowing money, neither debit cards nor prepaid cards will have an impact on your credit score. In fact, only a credit card will have an impact on your credit score. If this video is giving you value, write credit cards in the comment section. I'll do my best to reply to every comment I get. Credit card and debit card liability. Credit cards and debit cards are proving to be very different. Another key difference between the two is how they protect the user against fraud. As previously mentioned, credit cards offer a greater liability protection than debit cards. Credit card liability. Credit card liability is very simple. Your liability for fraudulent card use is limited to $50 under the Fair Credit Billing Act. You are not liable for fraudulent purchases if your credit card number is stolen but not the card itself. Additionally, many credit card companies automatically provide $0 fraud liability guarantee, which means you are not liable for any fraudulent charges made with your card. Debit card liability. Debit card liability is much more complicated and involves various timeframes. If a lost or stolen card is reported before it's used by someone else, you are not liable for unauthorized transactions. However, if you report a lost or stolen card within 2 business days, your liability is limited to a maximum of $50. If you report a lost or stolen card more than 2 business days, but less than 60 calendar days after receiving your statement, your liability is limited to $500. With me so far? Additionally, if you report a lost or stolen card more than 60 calendar days later, you're accountable for all unlawful transactions. However, if your card is not lost but is used to make unlawful transactions, you are not liable if you report them within 60 days of receiving your statement. Let me know which liability structure you think is less complicated in the comment section. Types of credit cards. If you're shopping for new credit cards offers, you've definitely noticed that there are a lot of them out there. The truth is that there are numerous types of credit cards available to users, and the offers and advantages may differ depending on the populations they serve. Do you have credit that needs to be repaired? You can get a credit card. Do you want to earn cash back or travel rewards? You can get a credit card too. But what are the many credit card types? Some of them include the following. Reward cards. Credit cards with rewards give you something back for every purchase you make. In general, these cards necessitate good credit. They come in the following types. You may get money back with cashback cards. You can normally acquire that money in the form of a check or a deposit into a bank account, or you may use it to pay down your balance. Airline and hotel credit cards offer miles or points that can be redeemed for free flights or hotel stays with the card partner's airline or hotel chain. Redeeming your rewards on certain cards may be subject to restrictions, such as days when you're unable to travel. General travel cards are many people's favorite kind of rewards card. They provide points that can be used to pay for any type of travel expense. They are more adaptable than branded airline or hotel credit cards. Co-branded credit cards or store credit cards reward your loyalty by providing discounts or other incentives when you shop at the store that issued the card. Cardholders who pay their bills in full each month are good candidates for reward cards. Interest cards eat away at the value of incentives when you carry a balance. Low interest. Low interest credit cards do not offer rewards. Instead, they offer the value in the form of a low interest rate, making it less expensive to carry a debt. Just to be clear, we at Smart Money recommend paying your credit card balances off in full on time every month. These cards frequently come with a 0% introductory APR period, providing you time to pay off a major purchase without incurring interest. To qualify, you normally need to have good credit. Balance transfer. Balance transfer cards exist in case you weren't able to pay off your card's balance in full on time every month. A balance transfer credit card allows you to transfer debt from another issuer to benefit from a lower interest rate. In general, these cards necessitate good or excellent credit. Cards for suboptimal credit. Credit card alternatives for people with bad credit are more limited. Rewards are harder to find and interest rates aren't as generous. Use these cards to enhance your credit so you can qualify for better deals in the future. A good card for ordinary credit will not have an annual fee or may give you rewards in exchange for an annual fee. A secured credit card is usually the best option for people with bad credit. These cards need a security deposit, which is refunded after the account is closed or upgraded to a regular unsecured card. In the long term, a secured card is less expensive than an unsecured credit card for bad credit, which typically incur exorbitant fees that, unlike a security deposit, are never refunded. Student cards. Being a college student does not guarantee approval for a student credit card. The Credit Card Act of 2009 prevents issuers from issuing cards to anyone under the age of 21 unless they have proof of income or a cosigner, someone willing to put their credit on the line to assist the applicant in building theirs. When that's not a possibility, a secured credit card might be best used to build credit. Why should you get a credit card? Debit cards are enticing since they do not require to borrow money and do not accumulate debt, but they also do not assist you in establishing a credit history. One of the primary advantages of using a credit card is the ability to build credit. Others include sign-up incentives. In the case of a cashback card, the bonus could help you create an emergency fund or go on a trip. Ongoing rewards. Rewards reimburse you for a portion of the money you spent. Building credit. Having a strong payment history can help you borrow money at a cheaper interest rate in the future. A 0% introductory APR allows you to avoid paying interest on purchases or balance transfers during a promotional period. Flexibility. While it's desirable to pay your debt off in full each month, a credit card allows you to pay for goods over time, which is useful when making large purchases or dealing with a financial emergency. What does a credit card cost? Credit cards have fees, but you can avoid most of them if you use them responsibly. They are as follows. Interest payments. Credit card interest rates, or APRs, can vary depending on whether the credit card is used for a purchase, cash advance, or balance transfer. Your purchases do not accumulate interest if you pay in full each month. Annual fees. Some credit cards have annual fees ranging from $20 to the hundreds of dollars. An annual fee may be worthwhile if the card offers benefits and features that outweigh the cost, but in most circumstances, you should not pay a fee just to keep a card in your wallet. Late payment fees. The cost varies depending on the issuer. However, federal rules limit the amount that can be charged for late fees. In 2018, the first-time late fee was limited to $27, while the fee for a second late payment with 6 months was limited to $38. Late fees can also not exceed the minimum payment due. Balance transfer fees. In general, balance transfer credit cards charge 3% to 5% of the amount transferred. Some credit cards waive the cost if you transfer debt within a specific time frame. Foreign transaction fees. Most credit cards carry a 1% to 3% surcharge on transactions with non-US merchants. These fees are normally not charged on travel credit cards, and some issuers do not charge them on any of their cards. How to compare credit cards. If you're looking for your first credit card or your next credit card, you should do some comparison shopping. When comparing credit cards, look for the following features. Regular variable APR for purchases. APR for balance transfers and cash advances. Promotional APR terms and conditions. Annual fees. Rewards programs. Introductory bonus offer terms. It's also a good idea to look into the card's additional perks and characteristics if any exist. For example, if you want to establish a travel credit card to earn miles or points toward flights and hotel stays, you might want to also look for ones that come with perks like airport lounge access or airline fee credits. If a card has an annual charge, it's a good idea to weigh the value of the rewards and the advantages against the charge to see if it's worth it. Credit card tips for 18-year-olds and anyone else who needs them. The advantages of using a credit card responsibly exceed the disadvantages. Here are some best practices to follow. Every month, pay your bill on time and in full. Maintain a balance that is less than 30% of your available credit. Between credit card applications, you should wait at least 6 months. Check your account online once a week to keep track of your spending and avoid fraud. To avoid harming your credit score, keep no-fee credit cards open and active. Using a credit card responsibly is a quick and easy approach to building good credit. You'll be glad you did when you're able to borrow cheaply in the future. Credit cards, when used correctly, can be a credit-building instrument. Paying your bills on time, keeping your balance low, and only opening credit cards when necessary can all help you earn and maintain good credit. Also remember that paying your credit card balance in full each month is the greatest method to avoid interest costs. That'll do it for this episode, guys. If you're interested in getting cool stuff and great educational materials, take a look at the affiliate links in the description. They're a great way to help support the channel. If you choose to use them, I will be compensated, but at no extra cost to you. Check out the videos on your screen on how to improve your finances. If you like this video, hit the like button so the YouTube algorithm promotes our video to other like-minded people. Be sure to subscribe and share the video with your friends. Thanks for watching, and I'll see you in the next video.